Welcome back to Ask a DHJJ CPA, the podcast where real CPAs answer real questions from business owners. I'm your host, Emma Yurchik. One thing we see all the time is that as businesses grow, their financial needs change, but their approach to finances doesn't always keep up. You might start with basic bookkeeping, then move into a more structured accounting, but at some point, good enough financials stop being enough. So today we're talking about that turning point, when it's time to start thinking like a CFO, and what does that actually mean for growing businesses? I'm joined by Mark Ruenz today. He's part of our outsourced CFO team here at DHJJ, where he provides part-time and interim CFO services to clients. He has over 25 years of experience working closely with growing businesses on budgeting, forecasting, and cash flow planning, helping them move from reactive to a more decision-making strategic focus. Thank you so much for being here today, Mark. I'm excited to hear your perspective on today's topic. To start off, I'd love for you to share in your own words what your role looks like day to day and the types of businesses you typically work with.
Absolutely. Thank you, Emma, for having me. Happy to be here and on the podcast. So my day to day, it really does vary depending on what client I'm working on and who needs what type of things, but it does absolutely vary in terms of one day I might be doing cash flow forecasting, as you mentioned, as well as the next day it could be helping out with an health insurance question that a company might be thinking about for renewal. Can I save on premiums, etc.? So it really can vary day to day. I can also get involved with doing financial forecasting and reporting to like benchmark against industry standards for that business. So again, it can really vary day to day, which is part of what I love.
Got it. Well, I think a lot of people hear that term CFO and immediately think big company, full-time executive, but let's break this down. How would you explain the difference between bookkeeping, accounting, a controller, and a CFO?
Yeah, very good questions. And I think they're all unique in their own way. And, by speaking of this, it's not to discredit one role over another, but there's advancements through the career of like an accounting role. And in that perspective, bookkeeping in my mind would be just more that day-to-day transactional person, recording accounts payable invoices and paying those bills on time, processing customer invoices and collecting and applying the payments against that AR that would sit on the balance sheet. Those would be typical bookkeeping type transactions or responsibilities. When you go into an accountant or an accounting role, that might include more engaging at month end to do like proper close processes, getting things in line, booking journal entries, things of that sort, to where a bookkeeper may not be comfortable doing those things. It really does depend on what level of complexity there might be in the journal entries that they're preparing on a monthly or quarterly basis. So that's kind of an accounting role there. A controller, in my mind, that would be more higher level, overseeing the I'll say the controls, the internal controls around segregation of duties, doing a more formal, maybe a financial report out of month-end close, quarterly close, etc. They can also get into the other operational areas of the business, inventory management, helping with like bigger, larger companies where there's customer master pricing type aspects, inventory, physical inventories, things of that sort. They might oversee those responsibilities and things of that sort. So a controller really is holistic on the whole business, looking at the ways to mitigate risk, things of that sort, support auditors if you have external auditors coming through to do annual audits, things of that sort.
Okay.
And then finally, on CFO role, he may look to a controller on where we at to date for actuals, but then he or she may be applying that on the go forward of that strategic look of what does that mean in 3 to 5 years if we're going to grow or expand or maybe take a division out of our business, et cetera.
Okay, so it sounds like the bookkeeping, accounting, controller, that's more looking at the, you know, past reporting, what's going on currently, but then CFO is forward looking. So where does the shift from reporting to forward looking strategy really happen? Is there a certain period of time where a business needs to start looking at what that future is really going to be rather than focusing solely on the reporting and what's happening today in the business?
Yeah, no, great question. And yeah, it can vary, honestly, on when that might happen. But in one situation, we could say, again, a CEO of a business or president, owner of a business, comes to his right-hand person in finance to say, I'm really happy with where we're at today, but I would like to grow my business and go externally beyond what we're currently capable of. So in a like, I want to go and acquire a business type scenario. It's a perfect example of where, again, a controller might be like, well, I can provide you all the actuals we've performed on, but again, strategically finding the right fit in terms of like what you would want to acquire. Maybe it's just one certain area of your business. You want to kind of bolt on some technology and acquire some software or something. So that's where a CFO would be more, I think, ready and able to help with that process and given assistance in terms of understanding, what books you're looking at for acquisition or what business you're looking at for acquisition, and then allow those conversations to happen at the, executive level inside your company.
Okay. So I feel like you really have touched on this, but is there anything else that you can think of that makes, that CFO level thinking different?
I would say from my experience and what I think we bring in terms of that CFO, a lot of times you have to understand, obviously, what is currently taking place in your business. A lot of times I feel as though once I get to understand the business or the industry that they're in, a CFO sometimes can almost see the writing on the wall before it's happening. So they can almost have a forecast of a predictable output if we don't change direction. So there's sometimes that initiative that they realize before it's happened. And then that's when you have to kind of redirect the ship and steer clear of that trouble, or just know that you're going to go through that and be financially sound to be able to survive.
Wow. Very, very important. Very, very helpful. So instead of just telling you what's happened, the CFO is really helping you decide what to do next, right?
Yes.
So let's talk about what this actually looks like in real life, because most business owners, I don't think, wake up and say, all right, today's the day, I need a CFO. So what are some of the signs that you're seeing that a business has outgrown those basic financials and is needing to get a CFO in there?
Yeah. I would say, to those business owners, in one way, if you're having, difficulty sleeping because you're wrestling with where you're at, maybe you're doing very well and you're successful and you're just wrestling with, is there something I'm missing? Those type of things are where just having that sounding board of, a fractional CFO come in and give you another perspective. And it could just totally be where you're going to get reassurance that you're exactly where you need to be. And again, we'll ask those difficult questions of, are you happy with where you're at? Are you looking to grow? Are you close to retirement? And right, we can do planning in all of those areas of, what are you happy with today? Why are you, what's keeping you up at night, right? Answer that question to us, and then maybe we can help either provide comfort in that exactly where you're at is what you need to be doing, or maybe there's a couple of adjustments that we can recommend. And of course, it's ultimately up to you. Our goal is to give you the sound financial recommendations, and ultimately you can choose if you take those or not. It's your decision as the owner.
Absolutely. I think two things that you touched on. It's two sides of a coin, right? It's the things that are keeping you up at night, but it's also the growth signals and the things that are going very well that may indicate that you're ready for that next step. Are there any specific growth signals that you could point to as signs that it may be time?
So it depends on your business, depends on your industry, of course, but I would say, if there are times when, and we've heard this from clients that we're working with currently now, like, they are getting reached out to, on a weekly, monthly basis for consideration of like acquisition, right? And they might have that question of, I don't know what my business is worth, those type of things, right? So those questions may come up, to where they just don't necessarily know if what is being offered is reasonable or not. So that's another area, again, in the CFO realm, we can help in quality of earnings and valuations for your business. But it could just be something where you've been with one insurance company for 5 years and you're like, I think it's time to go out and reassess what offerings we have. Are we covered? Do we have adequate insurance for what we do? If you have trucks on the road, obviously you want to make sure you're covered for everything plus, and you want to protect your business. So opportunities in that area are also important to consider and make sure that you are comfortable with where you're at.
Mm-hmm. That makes sense. I kind of want to shift gears a little bit because we're starting to edge on this conversation of, reactive versus strategic. So let's talk about that shift. What does it actually look like when a business starts thinking more like a CFO? How does that change decision making?
So I think, reactive is a lot of times you're putting out fire, right? You're realizing something went wrong, and you kind of have to fix that in order to move on. Strategic is, like I said in the earlier part of this episode, sometimes you can almost see it coming before it happens. And if you're prepared for that, again, you can maybe even avoid what could have happened if you didn't anticipate. And that can be for many things, right? And we'll get into some of these topics, but cash flow. There might be an old piece of equipment that you've had for years, and it's basically well beyond its useful life. And when's the right time to invest in that new piece of equipment? Maybe it's, end of your sale. Maybe it's when your cash is looking really good, but that can have, trade-offs in terms of, are you giving up operational cash for that capital need? And then 6 months from then, you're realizing you needed that cash for operations and things of that sort. So the thought of forward look and anticipation of what's ahead, and this goes into other topics we'll get to, budgeting, forecasting, it all kind of plays together in terms of, if you can understand where your business has been, where it's headed, that's makes our lives easier as CFOs to help guide you for what are the best decisions for any excess cash you have. Do you have equipment needs? Those type of things for reinvestment. Or again, can you think otherwise, acquisition wise, you want to grow and expand? Where can we best use your cash surplus, if you have that, and apply it towards your strategic goals going forward?
Absolutely. You mentioned in there that budgeting and forecasting piece, and I really want to talk about that and hone in on it. So how do you explain the difference between a budget and a forecast to clients?
Yeah, absolutely. First thing I always say, and I know many people don't see the value in a budget, but it is a goal. It is a guideline. I use the version of, or the sentence of, as soon as you press save, it's going to change. Meaning your budget file will not come out exactly as you budget. Your actuals will never align as you budget, but it's a goal and it's set in writing, right? Or a virtual save format of, this is where we want to take our company in the next 12 months, right? So that's a budget. Forecast is where I say you overlay the months of actuals into that budgeted file, and then you kind of repredict your 12-month look. So, right, let's say you're closing March year to date, right? Calendar year business, and you had a budget for the 12 months ending December. A forecast, you would have 3 months of actual and 9 months of a forecast. That still gives you a full year projection. And then you can compare that to your original budget and be like, am I on track or am I falling off of my original goal? And if so, in a positive way, negative way, if it's different, where? And then you start to answer your questions of why is it different? Are my employee headcounts way high? Are my shipping costs going up? Are my fuel costs going higher? Or, again, am I having savings that I didn't originally anticipate in my budget? That's a good thing, but that's fine. Then anticipate that in your forecast, and then that just helps your projections going forward as well.
This is very helpful in distinguishing between the two. And I have to say, what you said about budgets really resonated with me. When you're saying that the second you hit save, it's going to change. I can tell you just in my role with DHJJ, when I am creating a budget and it starts to change and adjust, it stresses me out. I don't like not going exactly to plan. So how do you help people navigate something like that and that stress?
Yeah, and it's a very tough area because some people are perfectionists and they want to say that their budget is going to actually take place. And I think it's just reality that over, again, the 25 years that I've been in the career, I've gotten comfortable with the fact that you're never going to come on exactly as you budgeted. So with that, just knowing that you have a budget, some people discredit putting that time in to create a budget because they say, what's the point? It's going to change tomorrow. Yes, it is, but at least it helps you and your business have a dedicated direction that you want to go and achieve by the end of your calendar year, right? So with that, you can even get more strategic in going like a 3 to 5 year budget where you're not just focusing on your 12 months, but you can get into like a rolling forecast budget of, I want to see, 36 months out, 60 months out in terms of if we stay the course as is, what's that trajectory look like? And if that's not where you want to be, then you have plenty of time in that to redirect and make changes and grow your business accordingly.
Yeah, definitely. I think this is a great way to frame budgets and forecasting. And I think it's very, very helpful. Thank you. So why is it important to update projections throughout the year?
So as I said before, what you budgeted will not take place. A lot of times you can be pretty spot on with your employees if you're not experiencing a lot of turnover, things of that sort, but undoubtedly things will change. So I think that reforecasts are really important to say, I accept what's happened. And if I want to achieve that ultimate original budget, if you're headed in the wrong direction, meaning you have too high of expenses or your revenues are behind plan, it gives you that time to redirect or mitigate how you're going to resolve those issues. It allows you to, again, if you lost a sales rep and you're realizing your sales are down, well, you got to hire that replacement and get those sales back on target. Those type of things allow you to identify, again, where you're seeing positives and negatives. And then overall, as long as you can explain and are comfortable with the variances to your original budget, a reforecast, it can look completely different than the original budget. You can change every single line item of your budget if you really want to be that aggressive. A lot of people just change 2 or 3 main levers, and then that way it allows them to get back on path to the original plan.
So, and correct me if I'm wrong here, but the way that you're explaining it, the way that it's resonating with me is it is less a hard and fast plan and more something to help you throughout the year to understand where you're going, where you've been, if there are any changes happening along the way.
Mhm.
Am I
Yeah.
understanding that correctly?
Yeah. Another phrase you could use is it's a guardrail, right? It helps
Yeah.
keep you on the path that you originally planned for. And to your point, the budget assumptions could be way off in one area, and a reforecast, it gives you the opportunity to update those assumptions that you put into the original budget, and then forecast in a closer to reality, closer to what is actually transpiring on your month to month actuals.
Got it. Again, thank you for running through this. I think it is a great way to kind of reframe how these are so useful rather than, like you said, some business owners, some people just in general working within business don't always like to hear the word budgeting.
No,
So
right.
definitely a
Exactly.
different way to think about it. So
Yep.
I'm curious, how does all of this tie into tax planning? Does it tie into tax planning?
It actually does, yeah. And cash flow forecasting. There's so many different areas that there's just those two topics of budget and then a forecast. In my roles, again, here at DHJJ, a couple of businesses that I work with, doing a budget and then being able to provide that to the tax team here at DHJJ and be like, this is where we're anticipating to go. It allows the tax department to do what they do best, and they can do their quarterly estimates based on what I'm feeding them by working with the business owner on this is what they think 2026 will be like. And then that way they can pay in their quarterly estimates evenly over the whole year, right? And be hopefully close to that. And then in a role of like, if there's a significant change to what we originally budgeted, and you do that reforecast and you're like, you know what, they're going to be making significantly more than what we originally planned, feed that to the tax team, and then those estimates would be adjusted accordingly. And then that way there's no surprises come tax filing. And that's the great partnership within your firm.
You mentioned cash flow forecasting as well, besides the tax planning. Can you dive a little bit deeper into that?
Yes, absolutely. And again, cash is king, right? In terms of the business, a lot of us learn that. So I think it's very important to be able to apply not just your original budget, but your forecast to, cash projection as well, as I'll put it. And in that term, a lot of times you'll take those forecasts and then you roll those through a cash projection process. And then that will obviously highlight areas or months where, maybe things are a little bit leaner and you have to watch your cash spend, perhaps make decisions or get a little more aggressive on collections, those type of things. Anything you can do to predict the future of again, I encourage clients to have a cash reserve for these dips where, things might get a little bit more lean on operating cash flow. So in that perspective, 3 to 6 months of operating cash in reserve is always good. But without that forecast feeding you to predict where your cash might go or be, it's difficult to know or again anticipate what is to come if things don't change or you don't deviate or make a change in direction of how you're spending your cash. So those type of things are always just good planning, and that way again you're well ahead of the lower end type worst scenario situations where cash is lean and you got to make really tough decisions as a business owner.
Mm-hmm. Yeah, I think you continue to highlight the importance of that strategic future look. I do want to shift gears a little bit and kind of talk about that flip side. So what happens when a business waits too long to make that shift from, focusing on the reporting and the today versus the strategic outlook?
A couple of things that can come to mind for me, Emma, is, one, say you're in a really tough industry where, valuable resources only come up once in a while and say an employee comes on the market and you take a pass. Hindsight, right? 3 months later, maybe you're like, oh, like if I only had known that my business was going to grow and that excellent sales rep would have fit in tremendously well and he would have just been onboarded and fully understood the business by the time you got to that 3 month mark. Those type of things, if you can predict that you're going to need that extra headcount in the months to come and a resource comes available, right? That's a missed opportunity where you could have had something great and then you're maybe left now to, hire the next best employee, of course, but it's just sometimes coulda, shoulda, woulda, type of thing of, I wish I could have, knowing at the time. Yeah. And that can come up with, again, the cash flow forecasting for a capital requirement. Again, maybe there's times of the year when you can get a better pricing on a piece of equipment or machinery or something that you may need. Again, some people wait till the end of the year to get that deduction in. And if you know earlier that was going to be a need, if your planning and forecasting was in line, maybe it wouldn't have been an end of year decision. Maybe it would have been mid-year and you could take full advantage of that asset for half of your business year, instead of just, 15 days of the end of the tax year, type thing for deduction, et cetera. And yeah, I mean, other things would be just the stress and whereabout of, are you doing the right thing for your business on a day-to-day basis? I feel like the more we can gain and give the business owners confidence in that what they're doing and the trajectory they're on is exactly what they told us they've wanted to accomplish, it's going to make them be better leaders in the business. It's going to make them be more confident in their day-to-day decisions. And ultimately, right, part of our goal as CFOs is get that financial information to the business owners as quick as we can, as accurate as possible, so that they can make the decisions for tomorrow. And I think knowing and those type of prompts where we can give that information to them just lets them feel much more comfortable in how they're running their business, and maybe they can actually enjoy a little bit more of not being overwhelmed with everything that they have to do business wise.
Sounds like a stress relief, financial stress relief, operational stress relief, all of that. The uncertainty too. Sounds like it helps with all of that. So we have talked about this already. When does it make sense to bring in that level of support? What are those key inflection points? We talked about growth, complexity, major decisions, transitions. But can you walk me through a little bit? There's the hiring a CFO option, right? But then there's also hiring a fractional CFO option. So I was hoping that you could walk us through what that fractional model is, how it works, what it means, and why that might be a good option versus a full-time CFO.
Yeah, absolutely. And, again, I think it really depends on every business, every situation that they're in. But speaking like a true accountant and CFO, if you don't have to spend the money to hire a full-time employee, does it really make sense to? And I think that's where DHJJ and our fractional CFO offerings, it might be a resource you need to use 3 times a month. And it could be heavy around budget time, right? So towards the end of the year, you're creating the budget for the next year. Okay, at certain periods of time when projects or specific needs come up, that's the perfect opportunity for, a part-time executive level member to join your table, offer their decisions or opinions towards your questions or needs. And I think from there, again, it doesn't require a full-time employee with benefits and the whole 9 yards for an executive level position. And again, we can come in with various models of how we offer our services to you. And in that perspective, you use this when it's required. Or if you have a one-off question, send an email and we'll get back to you, type of thing where we're happy to provide the guidance and direction when you need it. If you're in a good place and you don't need us for a month, that's okay as well. I think it's just, we're here. We're kind of on call and available.
Yeah, definitely. I think it's great for those growing businesses. We've kind of talked about, okay, what are those points that you need to bring in a CFO? Well, maybe you're hitting some of them, but not all of them. You're seeing the need for some assistance, but not a full-time hire. This fractional model is so helpful for the growing business. And just like you said, to bring in that support as needed. And you never know, it could uncover additional support that's needed.
A client that I actually helped on, it was we knew it was a temporary fill-in where the current CFO was kind of going to be put on special assignment for various strategic purposes with the business. And they basically contracted myself to come through there and help basically sit in his chair to keep the month-to-month close and reporting and team morale, going, enhancements where need be. And there were a couple of times when he would reach out with other things outside of like the day-to-days just to get my opinion on something. So again, it was like the buddy system where he had somebody available for a quick question that he wanted to kind of bounce it off in terms of another financial arm. So, again, that was the 6-month time where he was set up on a special assignment. And then after that period, it just transitioned right back to him. And I think, those offerings, they come up where maybe somebody needs to take a temporary leave and need a temporary fill-in. Those type of offerings, we can certainly help out with those.
Yeah, definitely. And I want to, admittedly, this segment is a bit of a shameless plug, but one thing we do differently at DHJJ is, we're not just fractional CFOs. We have so many other offerings. So can you tell me a little bit how our integrated approach helps clients?
Absolutely. And again, just touching on with my time here at DHJJ, I've seen it where, internally, we're working on a client and it could be from the M&A side, right? Maybe they're looking to be close to retirement. So we'll flip that opportunity to our financial planning and advisory services for retirement planning outside of once you sell your business. It could be something like we talked about before with tax, where maybe they have R&D credit considerations. They might have a full-time tax accountant, but if they use us internally, and we can provide, obviously, for planning purposes, that R&D credit and how we would want to manage the accounting for that and isolate those costs so you can easily identify. That's where we harmonize between our departments of, assurance, tax, the accounting services side where I'm at for fractional CFO, and then our financial advisors. It's kind of like we all really work well together and we play off of each other's strengths in terms of, if I don't know something, there's probably likely somebody inside DHJJ that does. So we put those questions out to each other for a response and feedback on.
So sounds like clients aren't just getting one fractional CFO, they're getting a team. They're getting everyone's knowledge, which is great.
Absolutely.
So I would say from our conversation today, if there's one theme, it's that thinking like a CFO means being forward-looking, strategic, and proactive. So what's one thing a business owner could do this quarter to start moving in that direction?
Yeah, I think, like I said earlier in the segments, if you're having unanswered questions with either yourself or, again, people at work that are around financial topics, and you really think that there's a way we can help, that's when you want to be reaching out. I think if you're hearing topics of question for, again, will this benefit my business? Yes or no? And you can't really find the resources within your available network. that's when DHJJ is here to provide some guidance and assist with those type of questions.
Mark, before we wrap up today, I like to ask my guests, if there is one thing from this conversation that you really want to, drive that point home and make sure someone walks away with the most valuable piece of information, what would that be?
Yeah, I think, Emma, for that, I've got to go with, if you don't set a budget today, you should be setting a budget tomorrow for the year ahead. It's going to be wrong, but at least it's something that holds you accountable, and it's something to work towards in terms of that goal. And I think with that, it might take time, but you'll probably learn from it. And I think for that effort, you'll probably see something out of the back end for sure.
Well, thank you so much, Mark, for being here today and talking through this with me. I really appreciate you being a guest, and I think that you have given such valuable insight to the importance of having a CFO, whether that's a full-time hire or it's a fractional CFO. And like we said, the importance of strategic thinking and forward thinking and those budgets. So thank you again so much. To all of our listeners, if you are out there thinking, we may be at that point, a great first step is to take a closer look, like Mark said, at your budgets and your forecast and ask yourself if it's actually helping you make those decisions or just reporting on what already happened. If you found this helpful, be sure to subscribe so you don't miss future episodes. And feel free to share this with someone else who might be navigating the same stage of growth. And if you have questions you'd like answered on future episodes, we'd love to hear from you. Thanks again for listening to Ask a DHJJ CPA, and we'll see you next time.